Hi, it's Terry Rudder here, and thanks for dropping in to listen to my money market commentary. Well, actually not just money market, but also a little bit of a rant about property and the new taxes, I guess would be the way to put it. Anyway, the official cash rate is still sitting at 2.5%, 90-day bill rates were down at 2.77, 10-year bond rate 5.87, Kiwi dollars sitting around about the 70 cents mark. So last week we saw that the government was looking at bringing in some proposed tax changes for homeowners, and anyone who owns their own home and or is planning to buy can breathe a big sigh of relief, because those proposed tax changes will not affect the owner-occupied properties. A land tax has been ruled out, which is a good thing, as it would have been levied in much the same way as rates, which is a blunt form of tax, hitting hard all those that own their homes as opposed to those who rent. The land tax would have had a negative impact on the lower incomes, our farming sectors and property owning charities. Capital gains tax has also been rejected. A rise in GST has been mooted though. So the likely tax changes for investment properties is where I like to have my biggest rant, because the big news there is in the government's opening parliamentary speech was the comment about trying to extract extra revenue from the residential property sector, which they believe, and I think unfairly, is not paying its way. After ruling out the capital gains tax, land taxes and notional tax return, the two areas the government is likely to target is depreciation and how much in the way of losses can be claimed. There are two types of depreciation, one on the buildings or improvements and the other for chattels. I think the change will only apply to buildings or improvements. The second change hinted at would be to ring fence losses to a certain level or restrict the offset to property income. The government has to be careful in changing these rules though, as many people have their only form of superannuation tied up in the sector. Also, the government should be encouraging landlords to continue improving their properties so that they improve their housing stock. These changes that they're talking about won't do this. If the sector is made unattractive to invest in, there will be fewer investors, and this may lead to rental accommodation shortage and higher rents. Higher rents will come anyway, because the landlords will pass on those additional expenses that they have. Currently, in my opinion, the landlords are already subsidising the rental market. So, do you think it's a good time to buy? The property market is quieter in January. Agents have put this down to two factors: number of people on holiday and the uncertainty regarding the new property taxes. For potential owner-occupiers, this has been removed and they can now consider whether it's a good time to buy. I think probably in the price bracket up to $400,000 we may see now those prospective homeowners coming out of the closet, or out of the cupboard. I shouldn't say out of the closet, should I? Anyway, that's my update for this week, my little bit of a rant about the tax, and I'll look forward to talking to you again soon. Bye for now.